Hello, everyone. Welcome to another session of Revise as Pro. And in this session, for all the US CMA aspirants who are in the final stages of preparation, we are going to touch upon a very important section, that is the external financial reporting decisions, which is basically the section A, part 1, and has a coverage of 15%. Again, in this particular section, we would be covering a specific area, primarily the financial statements. And in the financial statements, we know that if it is a general purpose financial statement, it includes the balance sheet, the income statement, the statement of changes in equity, cash flow statement, as well as the notes to accounts. Today, in our session, we are going to focus upon our area of statement of changes in equity. Generally, our focus revolves more about the balance sheet, income statement, and cash flow statement. And naturally, we have a tendency of avoiding around the statement of changes in equity. So, expecting that if some question bumps up across this specific area, we are confident and we are able to answer it with ease. With that in mind, let's move into the specific important areas that we should cover in the statement of changes in equity. So, moving ahead, in terms of what is there in store for us in this specific section. So as we normally go ahead, what can be asked in the exam specifically, very important is around the concept of the statement of changes in equity, its various components, and the transactions involving the SOCE. From a essay question standpoint, I think there might be some strategy question relating to the impact on the SOC account because of the changes in the components. Might be some journal entries that might be asked. So that should be our specific focus area in terms of what can be asked in the exam. Now moving ahead about the key points to remember. So firstly, we go around the basic and the components of SOC. So when we say the statement of changes in equity, it basically shows the detailed changes in each equity account over the course of period presented. So the period for which we are presenting the financial information, during that period, what has been the changes in each component of the equity account that is being shown on under SOCE. So what does it basically includes? So it includes the following: common stock, as we know, it is the common equity shareholders which will have the voting right. Additional paid in capital or EPIC, that is when the shares are generally issued above the par value. So the amount above the par value goes into the additional paid in capital, like the securities premium account that we are more conversant with in Indian accounts standpoint. Treasury stock, amount representing shares bought back by company, which is shown as a contra equity. Retained earnings are profit or loss in the period gets finally adjusted to the retained earnings. Accumulated other comprehensive income, or AOCI, is basically considering the other comprehensive income or loss which gets recorded in this account. Finally, the non-controlling interest is the portion of the subsidiaries holding which is held by the third parties other than the holding company, right? So that's basically around the statement of changes in equity components. So what is the next thing that is important to remember or to keep in mind? Firstly, what are the transactions and the accounting impact? So what are the type of transactions happening and what is the impact on SOC? That should be kept in mind. Firstly, the issue of the common shares can be at a par, at a premium, or a discount. So the impact really happens around my bank balance, my equity share capital or common share capital, as we say, the additional paid in capital in case the shares are issued above the par value, and if it is issued at less than the par value, then the amount goes to the discount on issue of shares. Then comes dividends declared and paid. So naturally, the three components that gets impacted: retained earnings, whenever the dividends is been declared, then the dividend payable gets created, and when it's paid, it is dividend payable to bank, right? Three accounts getting impacted. Net income or loss in the year ultimately increases or decreases are retained earnings. Other comprehensive income items, so it will increase or decrease the accumulated other comprehensive income. Then comes the repurchase of the treasury stock, or what you can say, the repurchase or the treasury stock is basically purchasing the shares of the company by itself. So the treasury stock increased, which is shown as a deduction from the equity balance whenever repurchases is happening. Then comes the stock split. That is again important, that it has no impact on our equity accounts as long as the par value is not changed to reflect the new share size. What does it mean? So for example, the stock split is in the ratio of 2:1, and earlier we are having 100 shares of rupees 10 each. Now we are converting it into post split, it's becoming 200 shares of 5 each. So the total share value remains unchanged at 1000. So there is no impact on our equity account balance. Then comes stock dividends, an important portion to keep in mind. So it's the additional shares are distributed instead of cash for the dividend declared, right? So how it happens? If it is a small stock dividend, how we define it? Less than 20 to 25% of number of shares outstanding. So what happens at that point of time, whenever there is a small stock dividend, we are finding that the retained earnings is reduced by the fair value of the shares issued. Share capital is increased by the par value of the shares issued, and the difference between the fair value and the par value is adjusted in the EPIC or the additional paid in capital. But when it becomes a last stock dividend that is greater than 20 to 25% of number of shares outstanding, then it is retained earnings reduced by the par value of the shares issued, and the share capital is increased again by the par value of shares issued. So there is no concept of the fair value coming into play here. So the treatment of small stock dividend and large stock dividend can be something which is important coming as a question as a MCQ, or rather all other components, what can be its impact in terms of accounting because of a increase or decrease, that can be something asked as a exam question. With that, we move into the next portion. What is important? A format. So this is something that should be clear in our mind, because sometimes we may be given some missing numbers in this format and we have to calculate that. So very simple format. If you see the statement of changes in equity, here is a opening balance of, I just presuming as 21 like that. So it has a columns of the common stock, EPIC, treasury stock, retained earnings, and accumulated other comprehensive income all makes up the total equity. So interestingly, you see the treasury stock is shown in negative because it's like a equity account, the contra equity account, sorry, reducing the balance of the equity. So whenever there is a purchase of the treasury stock that is happening, it is increasing the treasury stock balance, but at the same time reducing my equity balance. When there is issue of the new common shares, you see there is basically 10,000, that's the par value going to the common stock. 35,000 is actually over and above the par value, which is the securities premium we can say. So 45,000 is a total equity that is getting somewhere added to the transaction. Then the net income we see is getting added to retained earnings, and finally to the total equity. And other comprehensive income, there is a loss. So naturally the OCI loss is getting adjusted to the AOCI, and finally to our total equity. So that's the way how a statement of changes in equity account looks into. Now this might appear to be very simple, but generally they might be mischievous in the exam. They may just give you a missing 2 3 figures and they may ask you to recalculate and recompute. So you should be very careful in terms of the treatment of each of these components, that the treasury stock is a contra equity account, AOCI how is getting adjusted, and you will be able to compute the missing figures. Great. So with that, we just now move into what is there as a question for us. There is a problem to solve. Now, this is very important, that what can be asked. So I try to create a problem question that will help you out. Let's read the question. It says that the ABC company has 1 lakh common shares outstanding with $1 par value and market value is $8. ABC declares a 22% stock dividend. Okay, so it's a stock dividend. Be careful on that. So not cash, stock, fresh issue of shares. What is the impact on the various equity accounts if the transaction is considered a small stock dividend? And we have learned that what happens in a small stock dividend, what happens in a large stock dividend. The second option says, what is the impact on the various equity accounts if the transaction is considered a large stock dividend? So let's take it one by one. First scenario, small stock dividend, 22% of our 1 lakh is 22,000 shares. We have learned that when there is a small stock dividend, what happens is my retained earnings gets debited with the fair value of the stock. What is then created? My common share capital gets created by the par value, and the difference goes to the additional paid in capital. So here 22,000, that is my the 22,000 shares that will be multiplied by the market value, that is a fair value, that will go to my retained earnings debit. Then the 7, there is a difference that will go to 22,000 into 7, that goes to my EPIC, and $1 the par value into 22,000 shares goes to my common share capital. So let's quickly see the response to that. Yes. So how it goes? Retained earnings account is debited 22,000 shares into $8, 1,76,000 to a pick. There is basically the difference between the fair value and the par value, that is 22,000 into 7, 1,54,000, and common share capital, that is 20,000 into $1, 22,000 into the share capital. So that's about the small stock dividend. Coming to the large stock dividend, here again, the number of shares is 22% of 1 lakh, that is 22,000. And we are trying to compute, or rather show the journal entries, and we have learned that here the concept of fair value does not come into picture, and we are just considering the par value. So what happens is that retained earnings is debited by the yes, it is the retained earnings account is debited with 22,000 shares into $1 and common share capital again 22,000 into $1. So that's how the journal entry is going to happen. Apparently it is very simple, but if we do not practice the concept behind the entries and do not touch upon it in frequent intervals, we may forget. So it's very important to remember the treatment of stock dividend, and this may come as a question around any other components of the statement of changes in equity. So with that, let's move ahead. So specifically around statement of changes in equity, this is all about our small revision. So we learned about the components of SOC, how those components, when they change, what is the impact finally on the equity balance, and we also solved a question around how to make the treatment of a small stock dividend being declared and a large stock dividend declared. Hopefully this video is helpful for all of you, and we will try to circulate more videos around different topics. So please stay tuned to the Uplift platforms and subscribe and support us. Thank you.